Good afternoon, everyone. My name is Joe DeBrita. I'm a member of the JMRD Watson Wealth Management team. I work out of the London office, and I'm going to be the moderator on the call today. So I'd just like to take some time to thank everyone who's logged in. This is one of our first calls, and our first call like this on our baskets. So we do hope we get a little bit of feedback and tell us what you like or don't like. And we do hope to continue this sort of presentation as we move forward. One thing I will say is we are happy to make this a bit of a discussion. So if you have any questions along the way, you can ask them by typing your question into the live event Q&A box. And we'll get to those questions either near the end of the call, or if appropriate, we'll do it throughout the call today. So just to let you know, on the call today, we have Rob Watson and Adam Watson, two of our portfolio managers that work out of the Chatham office. We have Zach Davidson, portfolio manager from Toronto. And we also have Jaden Robb, who works here with me in London. So with that, I'm going to hand over the call to Jaden, and we're going to get started with a quick market overview and update of the year that's been so far.
Thanks, Joe, and thanks everyone for joining us. Obviously, as you've probably seen with the headlines, it's been a pretty rocky year, to say the least. There's been a lot of dramatic moves, both up and down in the market, and case in point, the pandemic, started to take its toll in February and March, and the North American markets dropped in some cases 35% from the peak to the trough in only 5 weeks, and that's an unprecedented move or an unprecedented decline. And if we fast forward to the end of the third quarter, the major markets have rebounded over 50% from the lows, and we're almost back, or pretty much back, to pre-pandemic highs. And again, this is kind of an unprecedented move to the upside. So again, wild swings this year. And the third quarter overall, it was a positive quarter for most major markets. September was a little bit rocky, but notable outperformance in the third quarter came from emerging market equities, which that's usually a decent sign for continued or some global economic growth. So that was an encouraging sign there. Now, the bulls and the bears have grappled with the fact that why is the market at pretty close to all-time highs, considering that unemployment in Canada and the US is still at recessionary levels, if you will. Now, it is better. The unemployment situation has improved over the last couple months, but still unemployment is rather high. Now, central banks and governments can get most of the credit for the market strength, and that they were quick to pour money into the economy to help businesses, to help individuals, to help households, and this avoided worst case scenario. I think this time versus 2008 and 9, again, central governments and our central banks and governments were quicker to react, and that definitely helped the situation in 2020. Now, most of the unemployed are unfortunately, from the service hospitality sectors, and most of those companies, or those types of companies, don't trade on stock markets. Now, conversely, the companies that have allowed businesses to flourish from home, like Apple, Zoom, Microsoft, etc., just to name a few, all these companies are major global companies that trade on global exchanges, and they've had obviously a greater impact on market performance this year. So this explains kind of the disconnect between the economic data, which is still, again, it's improving but lackluster, versus the market performance this year. Now, it's also important to note that the market is a forward-looking mechanism, and after the panic selling in March, investors, they shifted from a feeling of angst and fear to focusing more on, a potential vaccine, which a lot of companies are working on, and the prospect of higher corporate profits in the future. Profits have actually recovered more than I think what most investors and pundits have expected at this stage in the cycle, and that's also helped the markets stabilize and recover more quickly this year. And another factor is, with interest rates so low because of central bank monetary policy, and they're expected to be low for the foreseeable future, earnings are that much more valuable. and that results in higher valuations or people paying up or higher prices for these earnings, and that again translates into higher valuations for equities, which we've seen over the past few months. Now, going forward, there's no shortage of risk out there, but that's always the case. It's just different every year, right? And this year, it's the coronavirus and the second wave that's happening, and the election is grabbing a lot of headlines these days as well. And based on the polls, it's looking like the Democrats are set to be victorious on election night, but I think very few people predicted the outcome of the 2016 election, so it's maybe a little bit premature to anoint a winner right now. There may be more volatility to come as we near the election, and perhaps a little bit more after the election. But regardless of what party takes what executive branch of the U.S. government, more often than not, the markets are higher 12 months after an election. So that's something definitely to consider. All that being said, as you will hear from my colleagues in the next few minutes, we aim to buy companies that are leaders in their respective sectors, regardless of the noise, and companies that we feel will be compounders, over the long term. So that wraps up my market commentary for the year and third quarter, and I'll send it back to Joe.
Yeah, thanks, Jaden. That was a great update, and I'm sure we'll have some questions on some of the things that you've said there, and look forward to getting into that. So the purpose of the call today is to talk a little bit about our basket program, and we do share some of this information in our regular market observers, but we thought it would be a great idea to have some of the people on the call that manage these baskets speak directly to you. But just before we get to that, I'm just going to call on Adam just to talk a little bit about the basket program, maybe just for anyone who isn't as familiar with it. And I'll just put up the baskets on the screen here, as we do have some people on the call who might not know what we're doing in London or Chatham at this point. So Adam, go ahead.
Thanks, Joe. So I'm going to start out with what is a basket, and similar to an ETF or a mutual fund, a basket is a discretionary portfolio of stocks or ETFs. In the basket program case, it's managed by the 6 portfolio managers on the team. And the key part about a basket is everybody who's in the basket gets the trade at the exact same time and price when we see an opportunity. So in the dividend basket that Rob and I manage, kind of our major example is we owned British Petroleum BP in the basket when the oil rig blew in the Gulf of Mexico, and we were able to exit the position for clients in basically 10 or 15 minutes once we decided it was time to exit, and everybody got the same price as myself or my family members who were holding it at the time. I guess one difference to a traditional fund or ETF would be when you own the basket, you actually see the components and what we're actually holding. So it's more transparent and live, and it allows a little more interaction on some of the positions, which I'll comment a little bit more upon later. But the basket's a perfect way to get in a trade when we think it's right without exchanging phone calls, and get the exact same price as the portfolio managers on the team. So, Joe, I'll turn it back to you.
Yeah, that's great. Thanks, Adam. And as Adam indicated there, we're more than happy to share any information on any of our baskets if you're interested in the current holdings or performance or whatnot. We've elected not to put everything on this presentation, but all that information is readily available. So with that, Zach, maybe I'll ask you, in light of the current market conditions, did you make any specific changes to the baskets in Q3, and can you talk a little bit about the reasoning behind any changes that were made?
Sure, Joe. Thanks. So yeah, I'll review the changes we made for the respective baskets for the quarter. I'd say it wasn't too active a quarter. We had made some changes in Q2 to become more invested in the baskets. Starting with the all-cap growth basket, the first changes, we actually were a couple of sales, or one sale. We sold some Cargojet in early August, and the stock had a fantastic second quarter, the stock was up roughly 10% the day of the earnings, and it was our biggest holding in the basket. And so just because it was a little bit of an outsized move, we sold 10% of the position of the basket. And just to trim a little bit at that point, we sold Colliers, which was unfavored, and the stock had recovered, but also for the tax loss, knowing that we could probably revisit the stock within 30 days. And so we crystallized that loss as well. Colliers was a smaller holding in the basket, but was unfavored at the time. And then in August as well, we topped up a couple of positions. The markets had been a little bit weaker, and so we just wanted to sort of build up a couple of positions, and we added to 5 holdings, which were Silvercrest, Descartes Systems, Element Fleet Management, Enghouse, and Jameson. And specifically, that's how we try and build up our positions over time as far as adding to strength. And so 4 of those names were newer positions in May. And so we were just using some of the cash we had to build up those holdings. So that was it for the all cap growth basket for the quarter. For the dig basket, there was only one change, and it was actually a pretty good change and sort of highlights how our strategy works. But we sold Killam REIT. We had 4 REITs in the basket at that time, and Killam wasn't acting as well. It was unfavored in our relative strength rankings, and so we decided to sell that holding. And then we bought Boralex, which the timing was pretty good. Boralex had just announced a financing, so often stocks will pull back a little bit as they trade through that financing announcement. And so we bought the shares in the market as the stock was trading below the financing price. And just looking at it again today, renewable energy has had a terrific run of late. Boralex is a renewable energy producer, and the stock's up about 29% since we bought it, which we certainly didn't expect. But with ESG flows, as well as just general interest in renewable energy, possibly with the upcoming election, Boralex has had a terrific move. So that change has worked very well for the dig basket. And that was the only change we made actually for the dig basket in the quarter as well. And then for the US growth basket, we added Lowe's and Nvidia in September. And those were a couple of companies we had been watching throughout the summer. The US markets were really quite strong for much of the summer, and there wasn't much of an opportunity to buy these names on weakness. But we used the opportunity in September with the markets weaker through the first couple weeks of the month. So we bought initial positions in Lowe's, which is the home renovations company with retail operations in North America, and Nvidia, which has become a semiconductor graphic processing unit powerhouse. A lot of what goes into gaming and computers, electronics to make things faster, as well as automotive technology is really what has benefited Nvidia. So those were a couple of new positions that we bought, and we actually topped up those positions later in the month as well, just to build up those holdings. So they've really become sort of core, sort of 4 to 5% weightings in the baskets. So that summarizes the changes that we had made in the quarter.
Perfect. Thanks, Zach. Rob, I'm going to throw it over to you here now. Same question, if you wanted to go over some of the changes in our other 2 baskets and anything that you wanted to add.
Thanks, Joe. First, I'd like to welcome everyone to the call today. And again, thanks, Joe, for arranging it. Now back to business. We made 2 trades in the Watson Dividend private portfolio this quarter. The first, we reduced our cash position to increase our holding in Algonquin Power. There are 2 main reasons for this. Cash, as you know, is yielding near zero, and Algonquin Power pays a dividend of 4.25%. Also, Algonquin Power did a share offering recently to raise almost $1 billion to do a joint venture with Chevron Corporation to develop green energy. Algonquin is considered an industry expert in green energy. with a clean energy portfolio of wind, solar, and hydroelectric. This partnership with Chevron should provide growth for Algonquin for the next 3+ years. The second trade we made in the third quarter was the sale of Enbridge in favor of Canadian Natural Resources. Both companies have a history of raising dividends. Enbridge is in the pipeline and utility industry. Both are in the oil and gas industries. Canadian Natural Resources is Canada's largest producer of oil and natural gas, An interesting phenomenon happened in the first quarter of this year. Oil prices actually went negative. This was due to a storage shortage in Cushing, Oklahoma, and producers of oil were delivering oil through the pipelines, and they actually had to pay buyers to take the oil so they didn't have to pay the storage. This is the first time I've seen this phenomenon in the commodity industry in my years as an advisor, and it led me to believe that we may be close to the bottom of oil prices at a negative price. By switching from a pipeline utility to a producer increases our leverage to changes in oil prices and gave more exposure to one of Canada's top energy producers in the onset of winter where energy consumption generally increases. Back to you, Joe.
Perfect. Thanks, Rob. So I'm thinking what I want to do is I want to maybe look a little more in depth at a longer term performance of our baskets, because we've got a couple of anniversaries here that we think are quite something. And so Rob and Adam, we're a couple weeks away from the 12-year anniversary of the Watson private portfolio dividend basket. And so congratulations on that, guys. The basket has since inception annual compound return of 11.3% over that period. So, do you guys want to talk a little bit about your process and what has made this such a successful portfolio?
Thanks, Joe. If I could start, Adam, we follow about 20 different metrics for about 700 different stocks, and we reduce that down to 15 to 25 stocks across different industries for our basket. The most important metrics we follow are based on growing dividends, sales, and earnings. We believe sales growth properly managed leads to earnings growth, and we require management share the earnings growth through paying a dividend and growing that dividend. Our philosophy is earnings growth is the main driver of stock prices, and management's confidence in their ability to continue growing their earnings is illustrated to shareholders by increasing the dividend year after year. Our goal when we started the Watson Dividend Private Portfolio was to provide our investors with a market return with lower volatility, and we've managed to achieve that goal over the last almost 12 years. Adam, would you like to comment?
I'll just add that a good example of that we saw this week was one of the holdings, and Joe, if you want to flip to the holdings screen, Williams Sonoma. So Williams Sonoma, I like to say, is a name that clients love to hate in the basket. They sell high-end cookware, pottery, and home goods. So during the pandemic, when people were home and cooking maybe a little more frequently than they were used to, they realized that maybe their equipment wasn't as up to par. So Williams Sonoma came out and announced yesterday a 10% dividend increase. They'd paid off their revolving line of credit that they took out for the pandemic, and a share buyback again, which maybe hasn't been so common through most of this year. It's a company where 60 to 70% of its sales occurred online, and they were reducing their actual mall footprint, and had no debt leading into the pandemic. So they were able to get a line of credit to thrive and survive heading out. So that's kind of a great example of a company that we're looking for that that's maybe not as well known. And as you can see, it's up about 44% year to date through everything, and hit a 52-week high yesterday and today. So Joe, there's a good example. So I'll let you carry on.
Yeah, that's great, guys. Appreciate it. So our other anniversary is our all cap basket, celebrating 7 years in existence. So Zach, maybe you could talk a little bit more about this basket, the investment style, some of the holdings and performance as well, if you'd like.
Sure, thanks, Joe. So we started the all cap growth basket 7 years ago, October 2013, and really it was designed to be a complement to the DIG basket, which focuses on income securities. And so we started using it SIA charts, which is a relative strength screening tool, and we thought this would be a positive difference as far as having an independent tool screening growth companies in Canada and finding the leading stocks in their sectors. And so stepping back a little bit, what is relative strength? It's got a great long-term track record of success, and it's a simple concept, but really what it does is compares the price performance within a universe of securities. So SIA charts analyzes securities by their relative strength, and it provides a way to identify the leaders from the rest of the pack. And those are the market leaders that we want to own in our baskets. It also is a great tool because it identifies the laggards, and successful investing is not just finding the winners, but it's avoiding stocks that are underperforming, that could be undergoing negative changes. And those are the names we would want to avoid: bottom fishing, looking to see if they might bounce. We just want to own the strong long-term winners. And another way of thinking of this is sort of how the Canadian Olympic track and field trials occur, and you have athletes that race against each other, and only the winners end up going to the Olympics. And it's similar to how we look at the portfolios as well. And so often the future winners are current winners, and it's trying to identify those companies. And when we look back at this basket, there's actually 3 companies that we've held for 7 years, which are Parkland Fuels, Boyd Group, and Constellation Software, the 3 companies. And both of them were leaders in their industries, and they've only solidified their positioning as the years have gone on. Boyd Group's a fascinating story. It's a Canadian company. It's originally based in Winnipeg, but 90% of their revenue is now in the US, and they've actually become the 2nd largest auto collision and repair company in the United States, which I think is a pretty good achievement for a Canadian company. And they've just found a niche and run their business really well. And through our screening tool, it's remained one of the strongest holdings, and we've trimmed the position over time. So with this basket, we just focus on Canadian securities and identifying the winners. And most of these companies, again, are growth companies. Some of them pay a dividend. Initially, we look at buying a 2 to 3% position in these companies, and as they grow, we look to try and build that position. And then if the positions get too big, which is usually a 10% or so holding, we'll look to trim these positions. And often our biggest holdings today, Cargojet, Constellation Software, Shopify, we've at least trimmed the position once or sold it more than one time to reduce the size of the holdings, but the companies have continued to solidify their market leading position and have continued to grow. And so we want to still participate in that long-term growth. Another name I mentioned earlier, Cargojet, is an interesting story that I think we bought 3 to 4 years ago. And the biggest concern about Cargojet was really the valuation, and that's been a long time, argument that it was an expensive stock. And it's interesting because one analyst last week came out and said he upgraded the stock and just said the valuation is cheap, and so we try not to look too much or worry too much about valuation with companies. Good growth companies are going to grow into their valuation, and often, whether it's acquisitions or growth, they're going to exceed expectations over time, which doesn't mean they're going to beat every quarter, but they're going to continue to grow their businesses. And I think this year has shown with a number of these holdings that we still have, such as Boyd and Cargojet at the top of that list, that they've really solidified their positioning. Boyd Group raised money in April just so they'd be able to make acquisitions this year and take advantage of some of the changes going through the auto repair business. Another thing that's changed with auto repair is that, as we know, it's very expensive to fix a car. There's a lot more technology involved with cars, and so for smaller auto collision repair shops, it's tough to keep up. And Boyd Group just has a very good position. They work with the insurance companies. They have a great reputation. The insurance companies like that they turn their cars around in a reasonable amount of time, as well as a reasonable price. And so it's a win-win solution for a company such as Boyd. And so that's sort of the all-cap growth basket. And it's really, our goal is to own companies for the medium term to try and identify new winners. And if we can own companies and watch them grow over time, we'll be happy with the performance, which will take care of itself. And I think that wraps it up, Joe, as far as the all-cap growth basket.
Perfect. That is an excellent update. And again, I appreciate everyone for being on the call today. So we are going to have a bit of a Q&A session, and we do have one question here, very appropriate for the timing. So I'm just going to read it out, and I'm going to hand over the mic to anyone who wants to speak to this. And if none of you guys speak up, I'm going to just ask someone. So here we go. Obviously, we're in an election year. Do you think that the rally from the lows could run out of steam, as soon as the election is over, no matter who wins? And the second part to that question, will there be any trades in the basket to prepare for any potential messy election that the markets won't like? So yeah, anyone who wants to answer that, please.
Joe, I'll step up. Rob Watson here. Generally, the election causes a shift in leadership because each president has an area that they want to focus on financing in order to create the recovery that they want to recover. I think the classic example was when Donald Trump came in. He was very much into the fracking industry, and he poured money into the oil and gas business to stimulate fracking to enable the U.S. to become self-sufficient in energy. Joe Biden has a similar plan with the green energy. He wants to, at least early indications are, he wants to put money into green energy in order to deal with the climate change problem and stimulate the economy. So I think it's natural to have a shift from one industry to another in the flow through the election. And generally the president's inaugural address identifies those difference between the promises made going up to the election and the actual dollars spent in the president's inaugural address. They state where they're going to spend their money. So there's often a flow, and we've already started to adjust our portfolios to green energy to sort of hedge our bets depending on who wins the election. So I think it's a constant, and we sort of make changes as we see what's appropriate, and we've already started that process. Perhaps someone else wanted to add to that comment.
It's Zach here, and I would just add that, looking back at the last U.S. election and some of the sectors that were anticipated to do well under a Republican administration, we're sort of financials was seen as beneficiaries The thinking at the time, there'd be less regulatory oversight of financials. And the steel industry as well was seen as another sector, along with energy, which would benefit. And they've generally struggled. There's been a few winners in those sectors, but overall, they were not sectors that really have performed very well the last few years. So I'd say, you don't want to try and anticipate too much changes, because you also, especially in the US, there's whether it's the Senate, there's other changes that may or may not occur, and the market will be forward looking and anticipating some of the winners, and we'll start to see that as far as our screening tools. But at this point, I don't think we anticipate too many changes, and good businesses are going to continue to grow, and we'll see what develops over the next few weeks. But again, we're not really trading our baskets, we're more investors, and we'll see what develops.
Perfect, thank you. So yeah, we just have another question come in here on another relevant topic. We've obviously seen interest rates plummet this year, and there's been a lot of talk of inflation and the potential for rising inflation over the next few years. So, I guess the question is it possible to have low interest rates in a elevating inflationary environment?
Rob, again, I'll tackle this question as well, if you like. I think the federal and central banks can control the short-term interest rates, but they can't control the long-term interest rates. So as you get higher inflation, you should see a steepening of the yield curve. Even if the governments around the world, due to the high debts, want to keep the short-term interest rates low, they can engineer the short-term interest rates low, but eventually you're going to see the long-term interest rates go up with inflation, and that real return will restore itself as inflation gets, I'll say, out of hand. I think the world can tolerate 2% inflation, but when it gets into that 4%, the tolerance tends to slide. I'll open it up to anyone else that may want to add a thought.
Yeah, Rob, and it's Jaden here again. Central banks have said that they know that rates are low, and they're like short-term rates are low, and they are willing to keep short-term rates low, even if inflation does start to percolate a little bit higher to kind of allow for a greater recovery. So again, as Rob said, yeah, long rates will move up, and that may impact mortgage rates and may increase or GIC rates, but or on the longer end. But yeah, short-term rates can stay lower for a little longer in this situation, I think.
Perfect, great explanation, guys. So I don't see any other questions, so I think maybe we'll wrap it up here. Now, one thing I will say is if anyone does want to have some additional information on our baskets, the next couple of weeks we're going to be talking about them in our market observers, but we're more than happy to send along holdings or performance or our thoughts at any time. So feel free to reach out to any member of the team. And as I said at the beginning, we'd like to continue to do these sort of presentations. I understand maybe it might have been a little bit out of focus there for some people. So that's something that we'll work on going forward, but we definitely want to hear your feedback and let us know if there's any specific topics that you'd like to hear from us. Otherwise, we hope to plan to be back with a Q4 update in the same fashion. Anything anyone wants to add before we sign off?
Nothing else other than thanks for joining us.
Yeah, and if there's any follow-up questions, feel free to reach out.
Perfect. With that, again, thank you everyone for taking some time out of your day to listen to the call, and enjoy the rest of your day.